welcome. This is Ankita Pathak from DSP Mutual Funds. As a fund house, DSP strongly believes that it is the rules that rule. To that goal, our fund managers have documented their frameworks and their investment philosophies. They have and communicated it widely to our investors. But how do these frameworks work in real life? What are the opportunities and also the hassles that these frameworks create? And how do we resolve them? To decode this and much more, we have our Head of Equities, Vinit Sambre, joining us tonight. Thanks, Vinit, for coming in.
Hi, Ankita. Hello, everyone. It's a real pleasure to be here today.
Thanks, Vinit. So, Vinit, your investment framework is very well documented. At the very outset, I'd like you to throw light on the investment case for your style of investing. Where do you think does your style fit in an investor's portfolio?
Yeah, I think this is most relevant question, Ankita, and it actually takes me back to when I really started managing money for investors, and the principle, and this was in the year 2010. We had come out of the Lehman crisis. We had seen the 2008 fall. And before that, I had seen the 2000 fall as well, the dot-com boom and bust. When I got into managing investors' money, one principle which I had in mind was, how can we do a good job of really managing the hard-earned investors' money well, which means that, when we are investing into companies, we would like to sort of look at, creating long-term wealth for the investors. The other principle was that we would really like to eliminate companies, businesses, or managements where we have less comfort on, which actually reduces the chances of committing errors. So basically, it was a principle which was based on selection of good quality businesses and elimination of poor quality. So it was as much as selection as elimination, frankly. So I think that is the most important aspect. Now, where does this actually suit? I think it generally is well suited for all types of investors, just that many investors, they need to be educated that investment is really a long-term business, and it's not to derive returns in the short cycle. So those also are part and parcel of this journey. But most investors tend to get excited by the short-term return profile, and they miss the long-term big picture, which is really about what we call it a wealth creation. So from that perspective, I think it is very important to sort of have a framework which allows us to work in this fashion, and this is something which we have been following since the beginning. Just that we documented it 3 years back for our investors to understand our principles and philosophy well. We believe that if we keep following this framework of identifying good companies and eliminating bad companies over a period of time, this should work well, and it should achieve the objective of that long-term wealth creation, which most investors really want to achieve. Is my thought. The other aspect is that when we say long-term, we actually truly believe in that approach, and that is also seen from our portfolio actions itself, wherein when we try to buy companies, we are really trying to buy businesses. We hold them for long. Our churn ratios are probably the lowest in the industry. Why we hold them for long? As I said, we believe that businesses take time to flourish, prosper, grow, and create wealth. That is what we have sort of differentiated ourselves in terms of showcasing a lot of patience both while going through good times, bad times. We also go through bad times, because there are times when markets are in a raging bull phase and our set of businesses, companies are not performing. So I think we've gone through all of that, but we very confidently believe that this approach of identifying good companies, and probably as we go ahead, I will explain what exactly goes into the definition of these good companies. But that's what I believe should eventually lead to achieving the objectives of the long-term investors.
Sure, Vinit. So I think one big takeaway I take from this conversation is that it is meant for investors who are looking at long-term wealth creation, who are more patient, believes in the benefits of compounding. So now let's start with step one. You said elimination is as much a part of your framework as the selection. So we have 2000 plus listed stocks. What kind of parameters are used to get to your investable universe?
Sure. So, anyways, investors who might have seen our document or have not seen, I would urge them to look at it. We've actually given in great details what are the quantitative metrics which we really look at, but I will just explain them for the benefit of all. And beyond these quantitative metrics, there are a lot of qualitative aspects which we surely like to have a good hold upon before we get into any of these investments. So in terms of the basic let's say factors which we are actually looking at, I mean, where do we see that businesses can create long-term wealth, where businesses are durable enough, they have seen long cycles in the history, and they have not only survived and thrived, but they have through time grown, have achieved leadership profile within their business. And that is something which we believe is the real moat which any company enjoys, which has allowed them to grow in the past. And we believe that those moats, if sustained in the future, should give the companies the ability to grow. So what we are sort of looking for is the ability to sort of outgrow the industry. That is something which allows us to remain ahead of the curve. The second aspect, what we are looking at, is the longevity of growth for the business, which means that how long can the business actually keep doing what they have been doing in the past. And this is something which is which requires a lot of skill and judgment, and is also a area where it is possible that we may also go wrong at times. But I think growth becomes one important metric. Second most important metrics is the capital allocation decision by the management. This is the capital allocation decision actually really determines the future prospects of any business, because what you are investing today is going to deliver you over a period of time. Now, we have seen a lot of decisions being taken by the management in terms of the capital misallocation. Many times, they want to diversify into areas which are suboptimal in terms of the returns and all, and those probably are potential threats, or basically beginning where the companies then destroy wealth. So I think we are very mindful of how the capital allocation is happening. So for that, we really look at the ROC and incremental ROC for any company. That is one of the important aspects which we focus on. The other aspects is the profitability of the company, the margin profile, which actually in a way determines the pricing power through cycles, how the company has performed in the past. So we like to look at the history. We like free cash flow generating businesses. Businesses where the managements have managed the working capital well, and these are, and then we have some other ratios which we try to focus on, which gives us more data around the forensics, whether the companies they have genuinity in the numbers. So I think we look at the tax rate and few other aspects. And more importantly, beyond these quantitative metrics, we have the qualitative assessment of the management. Through time, their decision making, strategic decision making, is something which we like to see, so that we know that these management's interests are aligned to our interest and our investors' interest. And that's what actually are the basic factors which we are looking at as far as the companies go in terms of what we want. And the companies which don't really meet these are eliminated in the process.
Sure. Vinit, so we can see your detailed checklist on the screen, and there are, I think, 25 plus quantitative matrices that you very well defined. Now, among this, which are the top 3 variables, or which are the criteria that must be met without an exception, and why so?
See, I think the most important for us is the governance, and generally we have sort of not compromised on the governance, because we believe that this is one factor which can make or break the whole thesis itself. And hence the corporate governance is something where we pay a lot of attention to, while we also go wrong sometimes in our assessment. Many times the managements deviate from their stated objectives and defined path, and that's where we sort of then take a decision to even exit those companies where our assessment has gone wrong, or in the beginning itself, if we realize that this is an area where it can be a red flag at some point, we try to avoid those type of investment. The second most important, as I was saying, is the capital allocation, because I truly feel that capital allocation decision today is going to determine your PNL over the next 2, 3, 4, 5 years. And that's where we try to see whether the company is taking a right decision out there. And the third aspect is the return on capital employed, because eventually what one is looking at is the yields on investment. And I keep saying that ROC is like a interest on fixed deposit, but in the equity category, what you have to focus on ROC. This number keeps varying, but till the time it has remained above a threshold. For us, the threshold right now is about 15-16%. It keeps changing with the interest rates in the economy, but 15-16% is a good ROC to work with if the company has showcased that in the past and also has the ability to deploy capital in generating similar or better number. We like that. So I think governance, capital allocation, and ROC are, let's say, the most important aspect which we sort of look at as far as the companies are concerned.
So Vinit, now let us help us understand this with some more examples. I know governance is important to you. Do you think governance is a reason that we sometimes have intermittent underperformance because bad governance takes time to be revealed to the markets? So which are the, otherwise strong stocks that you have been able to avoid solely because your emphasis on good governance?
So anyways, there are, in fact, many examples where we have, avoided investments after actually having, done a thorough analysis of the business and the management. And maybe we might have spent a good amount of time as well in terms of, trying to understand these aspects. Upon not getting comfortable answers on some of these, we have avoided. So while I would, like to generalize in a way, it's very difficult to quote a specific name of a company, but I would say that, we were looking at a jewelry business. Titan is a great example of very well run and well managed business. We felt that just like Titan, there could be it's a big opportunity. So can there be other companies within the same universe which potentially can create similar wealth what Titan has done? So we were looking for the second or third tier jewelry names, and we didn't derive good comfort in terms of the accounting or the some of the transactions which were taking place. So we thought of avoiding, and it was a good decision in hindsight. Beyond Titan, I don't think any other jewelry company has created that kind of wealth. So I think that was an avoid for us. Similarly, we have sort of stayed away from pure play real estate businesses generally, while it's not a strict no for us, but we have avoided because the accounting out there is something which we feel it is difficult to sort of reconcile and understand. So that's one area which we have sort of avoided. infra companies, while they have a lot of good potential overall, but we are very careful here because again, the kind of accounting they do, and the, let's say, the poor cash generation track record, I mean, that has kept us away from many infra names. We have one or two, but very few of them generally. So I think in terms of the governance, clearly there are these areas which I could generalize, where we have sort of taken a decision to stay away broadly, and unless there is an exception within these, we would be open to look at, but by and large, these are the segments where we have sort of avoided taking exposure.
So Vinit, I guess you are very good at avoiding the red flags, and I recently read in one of your investor communications that it is a 75% of your portfolio that rigorously aligns to your framework, whereas the 25% is more of a tactical allocation. Now, how do you take that tactical allocation? How do you avoid that urge to, hug momentum? What are the steps that you take there?
So even within the companies which are at any point in time not meeting the frameworks, there are very fundamental reasons at several points. So, we witnessed, the COVID-led business disruptions taking place, and we saw many businesses actually, fell from their historical track records of, growing at a specific rate, which we look at. Many companies saw profitability-led disruptions, which actually meant that these companies, within our various quantitative metrics, many quantitative metrics didn't meet. So there are times in the cycle where companies are also going through cycle, and we recognize that these are, let's say, short-term disruptions, unless these are permanent damages to the business. And then we exercise patience to hold on to them, considering the fact that the core structure of the business has not got impacted, and the companies should revert back to mean once situation normalizes. So I think for a while it is possible that some businesses move out of the framework, and then we would like them to come back, and that's where a good returns can also be generated. There are times when we had identified a few of these specialty chemical companies when they were actually, frankly, out of my framework. I mean, in terms of their ROCs, they were single-digit ROCs, or capital employed was something which was very difficult to understand as to how things are going to pan out. But it actually was showing a lot of promise in terms of the growth prospects, the management's own internal decision, or the choice of getting to businesses which can generate superior ROCs. So those were clearly visible at that point in time. We felt that it is a good time in the cycle that we should allocate capital to these businesses, because as these businesses transform from single digit to double digit ROCs, which the management was showing very strong confidence upon, and good management, good clean management, we invested at that point in time. So we had looked at sort of turnarounds as well, and so when we are looking at those, we are definitely taking a call that these businesses are going to turn around, which can prove right wrong. But I think that's where many times the stocks are out of framework in those situations. But by and large, whenever we have taken decision broadly, some of the important metrics on corporate governance and capital allocation is something which doesn't get compromised. It is just that it is about how in the cycle these companies will sort of start reflecting the strong numbers which we are sort of looking at.
Sure, Vinit. So basically, it's a cyclical turnaround that you also focus on. And we started this conversation with you telling us that your framework is very apt for long-term investors. And I believe you are very true to your label, because your portfolio turnover ratio at approximately 27 is literally half the industry average. So when do you sell? What are the exceptions to your selling rules? I would love to hear some examples here.
So generally, we have a value principle or a value assessment of our businesses, that the companies, when we are buying over the next 3, 4, 5 years, as these businesses grow, these companies should attain a specific value number, looking at the prospects of growth and what the companies would sort of eventually deliver. Now, when we see that many a times in the cycle, it is possible that sentiments runs very high in some of these. As you mentioned, most stocks are in momentum. Not most, few stocks or many stocks are in momentum at certain point in time, and then there is a massive re-rating, which really makes the valuation look very expensive, and it really is more than capturing the intrinsic value which we believe the company should have delivered over the 3 or 4 years period. So whenever we have seen upfronting of these returns happening, we generally try and book profit out of those. As an example, we used to own Dixon. We felt that at certain point the valuations were looking quite premium, and then we sold off, and then once again now it is sort of come off, and then we again sort of took exposure because we felt the business anyways is strong. So one is the valuation itself when there are excesses which gets created. The other is when we see that the core thesis is breaking down. So let's say the company with a very strong pricing power, and there is excess competition which is going to sort of break the pricing power of a company and create a permanent sort of impact in terms of the outlook for the business. I think that's where we these are times where we have to dwell a lot more and try to understand the reasons, and then take a very calculated call, because it is possible that things can change and they may again regain their strength. But by and large, we look at the disruptive competition as a key threat, and then that we use as a reason to sell. And again, the last I would say is the adverse regulatory changes which impacts the businesses. Those we try and analyze the impact of those, and we feel that wherever regulatory changes takes place which are detrimental to the businesses with a long-term view, then there is those are the also reasons where we take a decision to sell the businesses.
Sure, Vinit. So I reckon it is when valuations are at an extreme, when the environment has changed because of disruptive competition, and when the regulatory environment is not favorable to your holding companies, and in the long term, you feel that things might still not get better, is when you decide to sell. Now, when has your process failed, and what steps have you taken in that environment?
So I think the framework is quite robust and in terms of our confidence about these companies. Just that many times it challenges us. It doesn't fail, but it challenges us that when we are largely going through a raging bull market, that's a period where some of our stocks, maybe because of some bit of conservatism which they have inherently in their businesses, they do not adequately participate. And there are many times cyclical rallies, junk rallies, which have sort of tested our patience in terms of the performance. So businesses are not as much impacted as the prices in the market, which we reckon that these are short-term deviations, and many times we have to sit through our positions. Only thing what we tend to do is that we keep going back to our thesis and rechecking, and if we keep getting the confidence, we have sort of increased our exposures in those companies as well. So generally we try to consolidate more and more into our high conviction bets when the prices keeps coming down, because we understand that the fundamentals have not changed as much as the price, and those also probably gives us an opportunity. The cost of all of this is that we have to go through a phase of underperformance. We have to sit through during that phase, and it also sort of leads to a lot of questions in the minds of investors as well, that why is there is so much of underperformance. But I think it's a part of our business. It's part of our strategy. When we have in a very disciplined manner followed this, so we do not like to deviate and sway away from the framework overall.
Vinit, we really appreciate the discipline that you bring to your style of investing. I believe setting up a process and then repeating it really helps in the long term. So, in your opinion, why do you think it is this framework that offers long term alpha generating capabilities?
Yeah, sure. So I think it is in a way linked to your first question. I strongly believe that as we keep identifying these companies, which anyways, as I said, they are leaders because of the strong moats which these companies enjoy. As they keep growing through time, we have seen that the weaker companies, gets eliminated over the period, and the stronger companies keep gaining strength, and they keep becoming even larger, stronger, and more powerful. So I think this allows us to be with companies which are really successful over a period of time, and also in the process eliminate weaker businesses, weaker companies. Also within our portfolios, we keep churning out some of these weaker names. At certain point in time, it tends to get into the portfolio, as it could have showcased strong potentials, but as I said, thesis breaks down, and we have to keep churning and eliminating some of the weaker business. So over time, I believe that what will eventually drive the value is going to be the fundamentals of the business. So as these companies keep growing at a rate higher than the overall corporate sector, as these companies keep generating ROC upwards of 16%, I strongly believe that that's the type of overall returns which in the long term such type of portfolio could potentially deliver is my thought. And I think that type of returns generally should beat most of the or should meet most of the investors' objective of beating the long-term inflation in a way. So hence I strongly believe that following this framework has the true potential of creating wealth for our investors.
Thanks, Vinit. Thanks for sharing your investment framework in so much detail.
Thank you. Thanks. Thank you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.